Imagine waking up to find your crypto assets frozen, your exchange account locked, and potentially facing serious legal trouble. This isn't a hypothetical nightmare, it's a very real risk for crypto investors in 2026, thanks to something called OFAC Sanctions. Interacting with a sanctioned crypto address, even by accident, can put your entire portfolio at risk. In this video, we'll dive deep into what OFAC sanctions are, why they matter more than ever, the dangers of tainted coins, and how to protect yourself from unknowingly violating US law. You'll learn how to safeguard your digital assets and avoid costly mistakes. So what exactly is OFAC? It stands for the Office of Foreign Assets Control, a powerful part of the US Treasury Department. Their job is to enforce economic and trade sanctions to protect US national security and foreign policy. Think of them as the financial watchdog for the US government. OFAC maintains lists of individuals, entities, and even entire countries that US persons are prohibited from doing business with. The most well-known of these is the Specially Designated Nationals or SDN list. If someone is on this list, their assets under US jurisdiction are frozen, and you're generally forbidden from transacting with them. For years, the crypto world felt separate from these rules. But that changed dramatically on November 28, 2018, when OFAC added the first crypto addresses to the SDN list, targeting individuals linked to the Samsung ransomware scheme. Since then, they've been regularly adding wallet addresses tied to hackers, ransomware operators, and entities trying to evade sanctions. This is no longer just about banks, it's about your blockchain transactions too. Here's the most critical concept you need to grasp: strict liability. In the world of OFAC sanctions, this means you can be held responsible for a violation even if you had absolutely no idea you were transacting with a sanctioned party. Let me repeat that: your intent doesn't matter. If you receive funds from a blacklisted wallet or send funds to one, you could be in violation of US law. This applies whether you're using a decentralized finance protocol, an NFT marketplace, or just a direct wallet-to-wallet transfer. The burden of compliance and the responsibility to know who you are transacting with falls entirely on you. This is a huge difference from many other areas of law where intent is often key. With OFAC, simply touching a sanctioned address is enough to trigger consequences. This makes due diligence absolutely paramount for every crypto user. The days of regulators seeing crypto as a niche hobby are long gone. In 2026, the regulatory landscape is rapidly expanding, and OFAC is a central player in this enforcement push. This matters to everyone, from the casual investor to the hardcore DeFi user. The IRS and other government agencies are getting much better at tracing crypto transactions. They're using sophisticated blockchain analytics tools that can track funds across multiple chains and through complex protocols. This means the chances of an accidental interaction with a sanctioned address going unnoticed are shrinking fast. Also, as crypto becomes more mainstream, traditional financial institutions and exchanges are implementing stricter compliance measures. They have to avoid their own OFAC penalties. This means if your crypto has any link to a sanctioned entity, even indirectly, you're likely to get flagged. Let's talk about the tainted coin problem. This is a major danger. When your wallet receives cryptocurrency from a sanctioned address, those specific coins can become tainted. This creates several significant headaches. First, if you try to deposit these tainted funds into a centralized exchange, their compliance systems will very likely flag and freeze your deposit, or even your entire account. Imagine your entire portfolio locked up because of a few tainted coins you received unknowingly. Second, there's the risk of transaction contagion. If you use those tainted funds in a DeFi protocol or to pay for a service, you risk spreading that compliance risk to other users and platforms. This can cause a ripple effect and further complicate your situation. Finally, a clean transaction history is absolutely foundational for accurate crypto tax reporting. Tainted coins can make your tax reporting a nightmare, potentially leading to discrepancies and IRS scrutiny. To illustrate just how serious this is, let's look at a real-world example from 2026. On January 30th, OFAC designated two UK-registered but Iranian-linked crypto exchanges, Zedcex and Zedxion. Why? Because they were processing transactions on behalf of Iran's Islamic Revolutionary Guard Corps, or IRGC. This designation included specific cryptocurrency addresses associated with these exchanges. This action isn't just about targeting individual bad actors. It's about targeting the infrastructure used for illicit finance. It highlights that regulators are actively policing the ecosystem across multiple blockchains. If you had any funds on these exchanges or interacted with their designated addresses, you could find yourself in a very difficult position. This isn't just about large institutions. It's about any individual user who might have crossed paths with these entities, knowingly or unknowingly. So, how do you protect yourself from these OFAC risks? First, always know your counterparty. For large or unfamiliar transactions, do your due diligence. Second, use reputable, compliant exchanges that perform their own OFAC screening. Third, be cautious with funds received from unknown sources. If you unexpectedly receive crypto, especially from an anonymous address, it might be best to avoid touching it until you can verify its origin. Fourth, consider using blockchain analytics tools to screen addresses before large transactions. Some services offer this. And finally, keep detailed records of all your crypto transactions. This will be invaluable if you ever need to demonstrate compliance. This is about being proactive, not reactive, when it comes to your crypto security. Navigating these OFAC risks manually can be incredibly complex and time-consuming. This is where tools like dTax become essential. dTax offers an OFAC sanction scan that checks all your connected wallet addresses against the U.S. Treasury's SDN list daily. It flags any sanctioned addresses you might have interacted with, complete with the entity name, helping you identify potential risks proactively. This feature is even available on the free tier. It allows you to get ahead of potential issues before they become a major problem. With dTax, you can gain peace of mind knowing that your portfolio is being continuously monitored for OFAC compliance. Check out getdtax.com. It's open source and free to start. Let's answer a few common questions about OFAC and crypto. First, can OFAC freeze my self-custodied wallet? While OFAC can't directly freeze the blockchain itself, they can sanction the addresses. If you try to move funds from a sanctioned address to an exchange or through any regulated entity, those funds will likely be frozen. Second, what if I unknowingly receive tainted coins? As we discussed, due to strict liability, even unknowingly receiving them puts you at risk. It's best to isolate those funds and seek legal advice. Do not attempt to transact with them further. Third, does this apply to non-US citizens? If you are a US person or if your transactions touch the US financial system in any way, OFAC sanctions can apply to you. This includes using US-based exchanges or services. The reach of OFAC is broad. The world of crypto is evolving rapidly, and so is its regulatory landscape. OFAC sanctions are a serious and growing concern for every crypto investor in 2026. Understanding the risks, especially strict liability and tainted coins, is no longer optional. It's essential for protecting your assets and staying compliant with the law. Don't let an accidental interaction with a sanctioned address lead to frozen funds or legal trouble. Stay informed, use the right tools, and always prioritize due diligence. Thanks for watching, and remember to subscribe for more insights into crypto taxes and compliance. See you in the next one.